Hi, welcome to another episode of Dr. Well's Beat and Ask. I'm Elvin, the founder of Dr. Well, and today we have Michele from StashAway with us. So thank you for coming to the show.
Thank you very much. Thank you for having me here.
Okay. Michele, can you tell us a little bit more about yourself and why do you start StashAway?
Yes, so I have started StashAway a year and a half ago, and before that I spent the first half of my career in and around financial services. I was advising banks when I was a consultant at McKinsey, and then I was an investor in private equity for a few years. And in the second part of my career, I built a few internet companies. I was part of a group called Rocket Internet, and in the last 4 years before launching StashAway, I was the group CEO of a company called Zalora. The reason I started StashAway was that during my 4 years in Singapore as the CEO of Zalora, I was saving money, and I kind of had the problem of accumulating cash in the bank account, and I didn't find anybody that was willing to help me invest that money. And I thought everybody just wanted to sell me incredibly expensive unit trust or investment-linked product. And I just refused to buy them. So I kind of kept accumulating cash until I found out about the existence of RoboAdvisors in the US. And this was in early 2016. I was still with Zalora. And I looked for a RoboAdvisor locally. I Googled RoboAdvisor Singapore, and I could not find any. And that's when I started thinking, maybe rather than just solving my own problem of how to invest my money, I can actually solve the problem for a number of people I talked to over the years that told me, yeah, I don't know what to do with that. And that's how, when I decided to look at it. And the real decision came when I met my two co-founders, Nino, the CTO, and Freddie, the Chief Investment Officer. They bring to the table so much more experience in areas where I do have an understanding, but I'm not so deep. And when I met them, I thought it's going to be impossible to build another team like this, like as strong as well put up together. And so we started. You know, Freddie comes from close to 17, 18 years as an investor. He was a managing director at Nomura. Brings to the table real experience investing billion and billion of dollars for sophisticated institutional investors. And Nino brings to the table close to 15 years of experience building technological companies. And and I have, as I mentioned earlier, kind of a little bit of both experiences, maybe at a more shallow level, and I scaled Zalora in this region. So we thought, let's do it, and now we are a year and a half later, and things are moving on.
Great. So it essentially is that you have identified a gap in the market, and you chance upon a good team, and that's how you brought things together.
Correct. I think the chances in the market is really, it's a huge problem, right? It is impossible that in a place like Singapore, if you have $200,000-300,000 or $1 or $2 million, you get served by a premium bank, and they will assign you a relationship manager, and they will just try to sell you unit trust with the crazy high fees. I refuse to do that, and I think it's a huge opportunity for someone like us to actually help customers build their wealth in a way that makes sense. It's 2018. Technology has changed so many aspects of our lives, and for whatever reason has not changed yet a lot about how we manage our savings, and it can do a lot. It can increase a lot the way to make it more convenient, to make it simpler, and very importantly, to make it much more intelligent.
Okay, so you mentioned about, which means you're quite frustrated about the current situation, how the financial industry is serving the retail investors or the individual investors for that matter. You mentioned high fees. Is that the only thing that you are not satisfied with?
No, it's not just the only thing. High fees is a big thing because, in investing, when you buy a car, you pay more and you usually get a better car. In investing, it's not, you're buying returns. So every 1% fee you pay more, you're actually reducing your returns. So it's the one product where fees actually are part of the product. So fees are very important, but it's not the only thing. So to me, the most important thing is the intelligence underneath the investment that you do, the investment framework that you buy. And I did not find anybody, and I have a few bank accounts, and I've talked to a few independent financial advisors, but nobody tried to think about who I am, what is my actual situation, and how does a portfolio look like, and what is the right level of risk, and how can I change my portfolio over time among different asset classes, among different geographies, different issuers of bonds. And that's a level of sophistication that, of course, 10 years ago was only for institutional investors and maybe ultra net worth individuals and family offices. But technology today can make it very simple. And so that's to me the core part. Then the fees obviously are important, and then the simplicity, the fact that you can take your phone and in 2 clicks understand what's happening to your portfolio and make sure that everything is under control. It's obviously an added advantage. But to me, the most important piece is invest in an intelligent, sophisticated way.
I see. So besides the high fees, you also felt that the competencies of the advisors were not there.
Yeah, I'm not going to go that far, but I felt that just the model it's very difficult to build a network of people that will give advice to customers, and it's very difficult to make it high quality. It's very expensive. It's very expensive. So maybe you can do it if for customers that have 10, 20, 30, 50 million. But below that, it becomes very expensive. It's very difficult.
Because you probably need a lot of training for the advisors to ensure that the quality are similar.
It's very difficult, and I think technology can help kind of bridge that gap and make it easier. I think the point is not really on bypassing the advisor. That's not what I'm trying to say. The point is building a product that is more sophisticated, that is more personalized, and that over time will kind of reduce volatility of whatever portfolio, whatever your risk profile is, and increase and maximize your returns at that level of volatility.
Okay. And so far, since you have been operating, are there any hate mails from advisors?
No, not really. Actually, I would say a lot of advisors, the more sophisticated ones, are actually reaching out, asking if they can collaborate with us. There is a few people in Singapore, very few, that actually do what is called fee-only based advice. And so they don't get commissions from the product manufacturers, so they're not biased like most advisors will be, but rather try to sell you a product, and I give you a financial plan or an estate plan or a tax advice for a certain fee. And those are the type of people that are reaching out saying, we feel there is a way to do things together. The more kind of general population of advisors, we don't have relationship with yet. But no hate emails so far. But we don't position ourselves. Let me clarify this. I think the biggest problem, if you look at it from a Singapore country perspective, the real issue in Singapore is that people do not invest, and do not invest in any way. So 36% of financial wealth owned by households in Singapore is in cash, on deposits. That's an issue. And what we're trying to do is helping people get that money to work for them, get that money to build their retirement plan, get the money to make sure that they can pay education fees when their kids are 18 years old, etc., etc., etc. And so we're not trying to steal business from financial advisors. We're trying to increase the options of the population to invest their money in a more wise way, and also to plan for their investment over time.
So you mentioned that, which means you feel that Singaporeans are underinvested and they have too much cash lying there and getting very low interest. And how do you get these people to be interested in investing or to even start putting money in robo-advisors?
So I would say there are 2 components of things that we do. So one is inherent in the product, which is we just make it easy. So to open an account with StashAway, it takes 15 minutes. So it's something we try to make it as easy as possible. And once you open an account and you've kind of built your investment plan and you have your standing instruction from your bank, in theory, you can just relax and do nothing. Then in practice, if you want to check, you can always find you can open your app, etc. So it's easy. So first thing is we make it easy. And secondly, we do a lot of education. So we do a lot of seminars, things similar to what you guys do, and we do it with a different twist, just explaining, maybe a bit more basic, explaining why does it matter to start early, what is compound interest, and why does it matter for every investor, and what is an ETF, and why are ETF a good tool to kind of get exposure to a variety of asset classes, why dynamic asset allocation makes sense, things like this.
How about those who are already investing, right? And maybe they are not getting certain results that they want. What message do we have for them? Do you think they should consider robo-advisors?
My honest point of view is that it is very difficult to beat the indexes by stock picking. I'll give you a couple of numbers. In the last 15 years, 93% of US large cap equity funds have underperformed the S&P 500, 93%. If you look at mid-market, 94%. Small cap, 95%. So you have a 1 in 20 odds to get a professional manager to pick, to select stocks and make more money than the index. If you are a non-professional manager, meaning that you do this in part-time, I'm assuming that the odds will be even worse. So if you go from 1 on 20 to 1 on 40, 1 on 80, maybe considering on buying the index is not a bad idea. That's the first point. The second point is, in reality, it's demonstrated that 80% of returns in a portfolio come from asset allocation, not from security selection. So it's much more important to decide whether you want to have 10% US equities or 20, or 5% gold or 15%, than to understand in US equities whether to buy Apple, Amazon, or all of them. And the answer should be all of them. So yes, I think everybody will benefit from actually having a more kind of holistic and sophisticated approach to investing. And of course, I understand it can be fun to invest, so I think it's fine to keep, part of your portfolio just for your, trying to beat us. Let me see if I can do better than StashAway over the next 3 years. I think that's fine, but I think the core part, your retirement plan, your kids' education plan, those things, I think they're better managed by using passive, very diversified instruments and building a smart asset allocation on top of it.
Yeah. So I guess one of the key things that you guys do is, besides asset allocation, is also rebalancing, which I guess individual investors will have too much effort to monitor and to rebalance at the right time, right?
So we do 2 things. One is rebalancing, which is making sure that the risk target is always constant, and therefore if one asset class overperforms other asset classes, moving over time the overall balance of the portfolio and the overall risk of the portfolio, we kind of sell that security and buy the other securities to make sure you go back to your target allocation. That has the benefit of keeping your risk constant to the risk level that, because of your timeline, because of your risk preferences, you have agreed on. This is done automatically by our platform, and it's not done periodically, which is what most people do. People tend to do it quarterly or semi-annually or annually. That's wrong, because you're kind of taking a bet on a day in the market. It's just not the right thing to do. So what we do is the machine checks daily and then performs a rebalancing anytime any asset class is away from its target by a certain threshold. The threshold differs across asset classes depending on their volatility. So, and this is demonstrated, there is a bunch of academic papers demonstrating that actually it's the right balance between let the good asset class perform for some time and then take profit without over trading and without time in the market. So that's rebalancing. The other thing that we do is that our asset allocation is actually dynamic. It's not static, meaning we don't tell our investors, look, you should have 5% gold for the next 30 years of your life. What we think is that because the ultimate driver of midterm performance for every asset class is actually the economy, you want, as an investor, to have a portfolio that is in sync with where the economy is. So for instance, in a recession, you may want less equities than when the economy is doing well. That equity, you may want to be more exposed to consumer staples than to technology, so more defensive sectors. You want more fixed income, more bonds, and maybe in particular you want more long-dated bonds that tend to do well in a recession. You want more gold. So all of those things are part of our investment framework, and we re-optimize automatically portfolios of our customers. Our customers can decide whether we do it automatically or if they want to have the last say. We offer that option. But most 99.something% actually select the automatic option. So we do for them, we do it automatically, and so that again we try to maintain risk constant, because in a recession you're going to have higher volatility, so risk spikes up if you don't change your portfolio. We maintain risk constant and we change your asset allocation so that you do as well as possible in a recession. Obviously your yearly return will still be less than in good times, just because it's impossible to do the same returns you have in good times, but still you're going to reduce significantly your drawdowns, you're going to reduce significantly your volatility, and you actually will make money over a certain period of time.
And we understand there are a few robo-advisors already established in Singapore, right? Can you tell us what are some of the unique proposition that StashAway is giving as compared to the rest? Yeah,
so I'm not going to talk about other people out in the room, but what I can tell you is where we think we put the bar very high. And the first point is what I just mentioned. When you're at the end of the game, when you invest with a robo-advisor, you're buying returns. So the most important thing you need to understand is how will they invest my money? And our investment framework is really sophisticated. I mentioned it earlier a little bit. So it's built on an economic regime logic. So we use economic data to make asset allocation decision. We had a layer of valuation adjustments, which actually under or overweight different asset classes depending on where the asset class is in the cycle. And we have a risk shield that actually is applied on top of all of this to make sure that the capital is protected for our customers. So that's our investment framework. And behind it, there is a lot of experience. I mentioned earlier that Freddie, my co-founder, has 17 years of experience managing large amounts of money. One of our advisors is Pranay Gupta, former head of multi-asset strategy at Temasek. He was the CIO Asia for ING, managing $80 billion. So these are all people that have managed a lot of money for very sophisticated investors, and that's how we build the framework. We built something very sophisticated. There's nobody like that, not just in Singapore, but I would guess probably globally, that have kind of built something as sophisticated and brought it to an investor for very low fees and no minimum balance. Now, so that's to me kind of the most important point. The fees, depending on how much you invest, we are a bit higher or a bit lower than the rest. So for a higher amount, we are cheaper. For a small amount, we are cheaper. For mid amount, similar. But honestly, I think fees are a very important component, as I mentioned earlier, but it's not the 0.1 plus or minus that matters. The important is cut out the 1.5%, and then select what you think is the right investment logic. I think from a platform perspective and usability, our platform is already kind of world-class and top-notch, both on the web as well as on the app. We're actually the only player in Singapore with Android and iOS apps. And this is just the start, right? We just invest in much more than everybody else, so the gap is just going to increase over time.
Okay, so robo-advisory probably is still quite new in Singapore. Unlike the US, probably the people over there are a lot more comfortable with it. So what are some of the safeguards that StashAway have in place to assuage some of the investors or prospects that may have some fear in trying out the product?
So first of all, we are regulated by the Monetary Authority of Singapore. So StashAway as a company holds a CMS license for retail fund management. This is actually another difference. We are the only RoboAdvisor in Singapore that owns in the company a CMS license. And that is by itself a big, I think, a big safeguard for investors, because that makes it, requires us to comply with the higher standards that MAS puts forward, including quarterly reporting, including tech audit, compliance audit, financial audits, including very high minimum capital requirement, and including things like the custodian setup. So that's maybe a very important point that is important to stress. Customers' money is always in custodian accounts with HSBC and Citibank. What does that mean is that in the event that StashAway were to have issues and go bankrupt, for instance, which we're not planning to do, but let's say that it happens, the customer's money is completely safe. It's completely separated. It stays with Citi and HSBC. That's part of the regulatory framework of MAS, and it's obviously the right thing to do on top of it.
So they are the trustees?
They're called custodian, but yes. So yes, so but trustees, custodian. Yes, yes. It's an omnibus account with the custodians. Yes. So that's on the regulatory front. On our side, we have quite a bit of internal safeguards. So because of our CMS license, one of the things we need to do is we have compliance in-house. So we have compliance team in-house. That's another difference versus other licenses. And that makes sure there is a person whose job is to make sure we are completely tight in many, many, many things that we do. And for instance, one of the things that we do is the algorithm, the asset allocation algorithm and the trading execution, they're actually not directly connected. We have on purpose an investment committee in the middle, which sits and reviews the data before trades are made. And that's done on purpose as a risk mitigation effort. Plus we have a number of kind of things that we have done to make sure that risk is under control.
I do remember just now you mentioned about this thing called risk cover, if I'm not wrong.
Yeah, risk shield.
Risk shield, right? Can you tell me more about it?
Yeah, so we monitor markets and macroeconomic data daily, and while we believe in an economic driven model, and we'll not try to time correction. So February, for instance, we didn't try to know when the correction starts, when it ends. It's not the right thing to do. It's impossible. You may get it right once, and the second time you get really burned. So that's not what we try to do. But what we try to do is, if there is a real bear market, we use economic data to anticipate it, because that's usually driven by economic data. And in case economic data have not anticipated, we actually have the risk shield monitors a number of different parameters, including leading economic indicators, including market data, we use technical analysis like death crosses to monitor on a daily basis, and we react immediately and put all portfolios in what we call an all-weather type of strategy. So it's not a recession strategy, it's not a growth strategy, it's not a stagflation strategy, it's an all-weather strategy. It is built to work decently well in uncertain conditions when you don't know where things are going. It's a transition portfolio for us. It's a portfolio until things are not clear, and it's not clear whether the market is going back to be positive or negative. We stay there. So that's something, again, it's a continuous process. So this can happen any day of the month, and we move immediately the portfolios there to protect people's capital.
And something I noticed is that especially after the 2008 financial crisis, the markets in US, Europe, and Asia seems to be disconnected for some matter, right? As in US have gone up, break new highs year after year, but Asia is still not even reaching the highs for some of the countries. And recently I read that the Europe just have some signal that there was a death cross. I just read it on Bloomberg, right? So if, let's say, in this kind of scenario where there's only one particular region where they have this death cross, but the rest of the other regions have not experienced that, and how would that risk shield work?
So the risk shield looks at, first and foremost, at the US market, because those are the ones that actually can tend to lead other markets, and then we have secondary checks on each of the markets where we're invested in. So in the European case, but one thing I want to stress is that we don't look at small corrections. So one death cross actually says nothing. We look at actually multiple death crosses, so it's a bit more analytical than that. Exactly. There's a variety of different things that we look at. So we don't want to overreact, because again, that's a mistake.
Okay, definitely. And speaking about that, the last thing probably we want to ask is, you probably met a lot of investors, right? And if they are still very undecided what to do with investments, do you have any advice for them?
Look, irrespective of the platform you decide to use, the way you want to invest, the most important thing is to be systematic, to invest on a monthly basis, dollar cost average, to diversify. So don't invest everything in the Singapore stock market. Don't invest everything in the stock markets. So have other asset classes. Those are the two most important things. So diversify time by dollar cost averaging, and diversify assets by investing in fixed income of different maturity dates and different issues, equities of different geographies, equities in different sectors, gold, real estate, whatever else.
Okay. So thank you very much for the insightful comments. And ladies and gentlemen, this is Michelle from StashAway. So if you are keen to find out more, do visit StashAway.com and sign up for an account if you are interested to try out this RoboAdvisor. And also they do hold seminars regularly. If you want to find out more, you can attend those sessions. All right. So thank you once again, Michelle, for
Thank you very much. Thank you very much. And yes, go to StashAway.sg and look it up. Thank you.
Thank you.